Hello, this is a special edition of Breaking the Mould that's going to look at, first, the reasons behind the surge in shares in GameStop, second, historic precedents, how they worked out and any lessons that can be drawn, and finally, what the long-term implications could be for markets of current events and indeed for investors and traders. And I'm going to try and do all of that in 5 or 6 minutes flat. So why have shares in GameStop surged? Well, GameStop's an American, loss-making, brick-and-mortar retailer of games, consoles and video games whose shares are traded on the New York Stock Exchange. It's got a new chief executive who's trying to develop its online presence. Now, the shares have seen what's known as a short squeeze. To short an asset is to bet its price is going to go down and profit from that. In the case of shares, a hedge fund, normally, will borrow the shares from a pension fund manager, pay them a fee for the privilege, and then sell those shares. If all goes to plan, the shares fall in price, the hedge fund buys them back, locks in their profit, the difference between which they sold and which they bought, and returns the shares to the owner. Job done. In this case, it's gone wrong. GameStop shares have soared and left the short sellers with big losses. Why? Well, the new boss of the company is talking about a new strategy, which frankly, though, he needs to do for a firm whose sales have dropped by a third in 5 years and that's made a loss for the last 3, but fair enough. But also, retail investors on social media have expressed disgust at short selling, piled into the stock to drive up its price and try and force the hedges to close out. And by doing that, the shorts have had to buy more stock, which takes the price even higher. The result is GameStop's gone from $40 to $325 as I record this in a fortnight amid a buying frenzy. Note, however, that an index of the most shorted stocks in America has been massively outperforming the wider benchmark since last November. In fact, it's doubled. This suggests it may have been a professional hit first, hedge funds forcing other hedge funds out of their positions by squeezing share prices higher, with retail investors cottoning on and jumping in to make a profit themselves, or in some cases perhaps just to make a point. What this has got to do with company fundamentals and investing is a moot point. Now, history doesn't repeat itself, but it often rhymes, was a comment from American writer Mark Twain, and bearing that in mind, have we seen anything like this in markets before? Well, the answer is not recently, but we have seen fights between buyers and short sellers since the UK stock market bubble of the 1690s, so it's not a very new phenomenon at all. But a very high-profile example came when the founder of the American retailer Piggly Wiggly, Mr. Clarence Saunders, took on the short sellers in 1923, and he did so with the help of legendary stock market plunger Jesse Livermore. Sanders and Livermore hurt the short sellers by forcing the retailer's shares higher, but Sanders got carried away and wanted to not just beat them, but hurt or even bankrupt the short sellers. He overstretched himself as he borrowed to fund his stock purchases. The New York Stock Exchange intervened to maintain an orderly market by suspending Piggly Wiggly's shares, although some saw that as Wall Street protecting its own from an interloper, and the suspension meant Sanders had no cash to fund his debts. Once the shares started trading again, he was on the rack, his banks panicked, sold his shares from at a loss, and that started a downward spiral. Sanders went bust. Note the key themes: use of margin or borrowing, plus use of derivatives or options. How getting out of the position to lock in a profit proved very difficult, if not impossible. How regulators intervened, potentially to the detriment of the outsider, but certainly to maintain market order, as they saw it. And how the attempts to force prices to sustained highs ultimately failed as a result. Now, there is no guarantee of history repeating itself, absolutely none. But these are all dangers of which investors and traders need to be aware. So thirdly, what are the wider implications for markets? Well, much of that will depend upon how this plays out over time. Social media traders, as I speak, are apparently moving into the silver market, and silver miners again to try and give Wall Street a punch on the nose, because precious metals are a market which is rife with allegations of and fines for price rigging at investment banks. Very quickly, here are 3 things for you to ponder, and the topics on which you'll have to form your own opinion. First, for GameStop. The Sanders failed to make a profit, even though he drove the price up of Piggly Wiggly. Now, at some stage, holders of GameStop might want to lock in a gain themselves. Then the question is, who will want to buy from them, given that the share price gains and the valuation now attributed to the stock are pretty lofty. As I record this, GameStop's got a market cap of $23 billion, or just under £17 billion. For reference, that's about the same market cap as Associated British Foods, the 30th biggest stock in the FTSE 100, and a firm which, through its ownership of Primark, British Sugar and Twinings, was making £1 billion a year profit before the pandemic. GameStop's lost money for 3 years, though it is trying to change and improve its business model, but you now have to decide what it may be worth, not just what it's priced at. Second, for markets, well, it's tempting to say that this is a sign of overheated markets fueled by cheap money and margin debt, but only time will tell. Cash in the banks earning nothing, governments and central banks are pumping money at the economy, and some or a lot of it's finding its way into financial markets. This is a common cycle in financial market history, and once markets get hot and bothered, they can stay hot and bothered for a lot longer than you think. Equally, when the downturn comes, it can come quickly. Hence the old saying about markets riding the escalator up and the elevator down, because not everybody can sell at the price they want, in the size they want, at the time they want. Buys have a bad habit of disappearing when you need them the most. Thirdly and finally, what are the implications for investors and traders? You will have your own view on whether the GameStop situation is investing, trading, or gambling. And I'm not going to tell you what's right and what's wrong, because I don't want to sound like your dad for a start. It all depends upon the eye of the beholder. But anybody joining in must be aware of the risks as well as the potential rewards, and ensure that any purchase or sale they make fits with their overall strategy, target returns, time horizon, and appetite for risk. Do what works for you. When it goes well, long-term investing is turning time into money by picking companies with good business models, sound finances, and competent management, and buying them at a fair valuation. Short-term trading is trying to time the movement of money and fathom where it goes next. Neither's easy. Disciples of investing argue that it gives them more downside protection should something go wrong, but in the end find out what works for you and stick to it. Departing from that path can lead to trouble. Investing in something you don't understand nearly always does, especially as financial markets are at their most treacherous when making money looks easiest. Just think of the peaks in 1999 or 2007. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.